Welcome everyone. This is another edition of the Exchanging Ideas and Espresso with Buyside. And today we have in agenda as an item of discussion the derivatives market. So we're going to talk about the usage of derivatives, benefits of utilizing derivatives, and implementation of those into the portfolios of the asset managers. We have the pleasure to have today with us Gilbert Keskin, who is the head of convexity at Amundi, and Massimo Giorgini, who is the head of equity and derivatives markets business development for Borsa Italiana. Myself is Michele Troiani, and I'm heading the institutional investors relationship for EMEA and Asia here at Borsa Italiana. So thank you guys for joining us. I think, let's go straight to the discussion. Maybe starting with you, Gilbert. Can you perhaps, introduce yourself and tell us a bit about your business model at Amundi?
Yeah. Good afternoon, everyone. So I'm Gilbert Keskin. As you said, I'm heading the convexity solutions team at Amundi. It's a team of 8 portfolio managers dealing mainly with derivatives, and the aim of the team is to offer either pure strategies using derivatives only, and we are running, for instance, volatility strategies, which are using volatility as an asset class and a good diversifier for customers. And in order to expose ourselves to volatility, we use essentially derivatives, listed derivatives. And the second kind of strategies we are offering to our customers are mainly dedicated solutions, using again derivatives in order to enhance the risk return profile of their equity investment. So it's mainly called the overlay strategies, where we are using derivatives as a way to give an asymmetric profile between upside participation and downside participation of the equity market for the customers. So, as I said, it's 8 portfolio managers, and we are doing it for many years now. I'm working at Amundi for more than 20 years, and we have a long track record in using derivatives.
Thank you, Gilbert. Your 20 years, experience at Amundi. It's encouraging. You look much younger. Let's put it this way.
Thank you.
You're surviving very well. Massimo, what can you give a bit to us the overview of essentially obviously of your role and what you do, but also on how it has been for Borsa Italiana the last 12 months?
Yeah, of course, and grazie to Gilbert and to Michele for the opportunity to share this Espresso time. So I think the current now event at Borsa Italiana. And as mentioned before, my name is Massimo Giorgini, and I'm heading development of Borsa Italiana equity and derivatives markets. But before addressing your question, let me do a little bit of introduction of the IDEM market. So basically, IDEM is the equity derivatives, is the derivatives market of Borsa Italiana, which is now part of a very recent change, part of the Euronext group. And it's offering global access to all the Italian equity derivatives products, with, I will say, at this point in time, an established leadership position in the core offering, which is including, as probably most of you knows, the FTSE MIB derivatives and the Italian single stocks. The Borsa Italiana market is featured by an extensive international client network, and one of the markets with the highest number of market makers, and probably also the lowest level of liquidity fragmentation on single stock derivatives, something that we will try to retouch later on, talking about the issues that buy-side investor players are facing these days with such a volatile environment. And just to give you a few numbers, in Q1 2021, it has been trading more or less 7 million contracts, which is corresponding to circa 200 billion euros of value traded. So a niche market with a very high potential. To answer your question, Michele, volatility has been clearly increasing sharply during the COVID outbreak last year. And for the first time, let me say, another very important point that I want to make also later today, a number of paradigms of finance has been cancelled out in a while, including the ability for example, for companies to pay regular dividends, like in previous year, okay, by regulatory reasons and obstacles, with a significant impact on derivatives markets, in listed option markets, in particular in structured product markets. Having said that, Borsa Italiana has been, I would say, always operated normally, showing strong resiliency of the platform. We never interrupt, discontinue trading operation. Also in turbulent times, notwithstanding, as you can imagine, the number of orders, the huge amount of orders and quotes the exchange has been receiving during the peak days. What I would like to say is that also the market making community, which is very, very important from an exchange standpoint, stayed fully committed in providing continuous liquidity to the benefit of final investors. And this is a very good point as an exchange operator. And what we have done, we have spent the full year, I mean the last 12 months, in rolling out new market microstructure announcement to promote, to foster screen liquidity, but also to facilitate, as we will see later today, a number of block trading type of operation. And on top of that, clearly, we continue to perform our core role, which is onboarding new trading firms and new market making entities.
Thanks. Let me interrupt you there. I think you touched a very interesting thing on the market structure, participation of retail, participation, the role of market makers, and I think this should be a discussion of another exchanging ideas as well, because it's obviously a very hot topic globally in terms of retail participation and how the market structure is evolving. Gilbert, Massimo obviously touched on the kind of very peculiar time, very volatile time in 2020, COVID crisis, markets upside down. Can you give us a bit of an overview or like some insight on how it has been for you guys? What have been the strategies that have worked the most, the best, and what are the lessons learned as an industry?
Yeah, for sure, 2020 has been a very interesting year because first it has highlighted how risky could be the equity market in terms of drawdown management, etc. But also how fast the recovery has been. It was very difficult for people managing their exposure and their risk by cutting the risk at the wrong timing. It was extremely challenging, and the usage of derivatives has first shown the interest. Last year has been a very good year to show that downside protection could be very useful by the usage of derivatives. But at the same time, when you look at the fast recovery we faced, it has also highlighted that if you are just a passive manager, okay, you can reduce your drawdown, you can avoid maybe a large part of the losses. But at the end of the day, if you are not managing actively your derivatives, you can give back everything. So, and our strategies has been extremely powerful last year, both, I would say, volatility strategies as well as overlay strategies. And the reason for that, it's not only because we were offering protection, it's also because we were managing actively, and that's what we did over Q1 and also afterwards, managing actively the exposure, rolling the options, taking profit. All these kind of active management has shown the real added value of giving the or at least the management of such strategies to professionals who are monitoring it on a daily basis, like we are doing. Otherwise, again, as I said, you can give more than what you gained over the time of crisis. So for me, if there is one lesson to take from 2020, is that convexity is interesting, downside protection is very interesting, but active management is even more.
This is a very interesting point of view. I mean, I recall it also speaking with you probably a few months ago. We were discussing how from announcement of a stock position with derivatives. So you own the stock and you sell the call. You comes into the wider group view, as probably those are 8 PMs that you manage do as a portfolio, right? Enhancing the portfolios, which is probably what what you were clearly describing. Massimo, what are the latest instead of Borsa Italiana in terms of business development? In line with perhaps what is the market and what are the investors and the community request?
Yeah, grazie Michele. I would like to link to last point made by Gilbert, because this is quite interesting. It was a very interesting year because of market volatility, but 2020 was a peculiar year also in terms of ramification effect of new regulatory provision at pan-European level. Okay, in particular, I will say that as in many sectors of our life and experience, the market turmoil has been probably accelerating a number of trends that were already there before the pandemic, but just not fully unleashed. So, for example, I would say that both sell side, but in particular, what we see from an exchange standpoint, the buy side investor needed to address the specific and increasing complexity around, for example, fast-changing financial regulation, including capital requirements, but in particular, I would say the ability to manage the execution toward addressable liquidity. I think this is something that probably Gilbert can confirm based on its own experience last year, when the market were very volatile and at some point relatively illiquid, particularly in some weeks. So basically, the buy side are now probably focusing more on the evolution of market liquidity, investing in particular in streamlining the trade processes, and even more important, probably moving as much as possible to electronic execution, away from probably the phone kind of relationship. We perceive as an exchange that last year was the time to raise the bar also on the exchange side, and we started to develop new trading functionalities able to cope with the specific sell side and buy side client demand. In April this year, indeed, we have launched a new trading functionality that is called client price improvement, which is exactly addressing the buy side needs in terms of execution capability and in terms of addressable liquidity. I don't know, Michele, if you want, I can dig deeper into detail by showing a few elements of this functionality.
Yes, go for it. I mean, maybe it would be interesting to see an example of if you have like the slide with the book, so that it gives like also practical.
Yeah, I will go very quick on it. So just to recap on the regulatory need, which is the trend behind Michele, the one you were mentioning before, as probably most of market practitioners know, MiFID II has been introducing a full transparency regime for all derivatives transactions. So basically, what we are already used to for cash equities, translated into the derivatives business, basically preventing the execution of bilateral transaction below large scale threshold. Clearly, this has posed some operational issues also to buy side investor. And in order to facilitate the execution of these trades below large scale, the other market has created a new type of order, a new type of functionality called CPI, a very straightforward way for describing the functioning we will see in a few seconds, which stands for client price improvement, basically allowing the direct member of the exchange to continue offering liquidity to their buy-side customer, providing that the trade is offered for execution first in the central limit order book. So basically, without disintermediating the liquidity already available in the order book. At the moment, we have opened up this functionality only to the option business. So basically, it is covering the FTSE index option and Italian single stock option. How does it work? So basically, an either market participant, any direct member of the exchange, has the opportunity to execute a pre-agreed transaction for one of his clients under a couple of conditions. First of all, he's using its own capital against the client, and second, the transaction is again offered for execution in the central order book. Okay, so basically, let me reiterate this point. This functionality, for the very first time, is liquidity addictive. Okay, So when the trade is agreed between the client and the bank, for example, the participant is sending the order to the market, to the matching engine. At that point in time, there is a new trading phase, which is called price improvement period. So basically, the buy side investor who is trading against the broker can benefit from basically an improvement in the execution condition, because there is a predefined time frame under which all market participants of the Italian derivatives market can react and improve the best BBO prevailing at that point in time. At the end of the improvement period, basically the client order can get executed against the order book, also therefore at possibly better execution condition. So basically, what are the key advantages of this functionality? First of all, is facilitating execution in a tough market environment. The second one is ensuring that the client is receiving full execution, but also the full benefit of a possible price improvement. And what is very important is that thanks to the interaction with the central limit order book, it is encouraging all market participants, including the 20 plus market makers available on the market, to improve the current screen BBO. Let's go straight to an example, which is very simplified. Imagine that a final investor wants to trade a FTSE MIB index option, okay, on the flagship index. There is a client order which is entering as a CPI, enter as an aggressive buy limit order at 99.9 for a quantity of 20. So as you can see from the order book on top of the slides, that is the situation before the price improvement is starting. The order is entering the matching engine. It is part from a very small time frame plus a randomized period. And what happened is that in the meantime, during the improvement period, new orders are joining the central limit order book provided by a number of electronic market makers, the one that you can see in red. And what is the final situation? The final situation is that the buy side willing to invest, willing to buy the FTSE MIB index option, not only is executing at least for the price delivered to this broker, which is 99.9, but also can get a price improvement for half of the trade for 10 lots at 99.80, thanks to the response, to the fast response, probably by a liquidity provider that want to participate in these trades. So the functionality is very innovative.
So
again,
somehow Massimo is the kind of equity market structure with the price improvement and order sweeping that is essentially serving also the option market.
Correct.
Yeah.
It's a quasi.
How long do you expect that session to last for the price improvement?
Yeah, the price improvement period is lasting half of a second, which is in today's market is a considerable time. We know that other exchange operators are operating with a different, smaller time frame, but really we wanted to provide this facility and the ability to respond to the widest part of the ecosystem.
Thank you. I'm sure that we will put the link with all details in the comment of the post and of this video. Let me go back to Gilbert. Gilbert, and thank you, Massimo, for the slide. Gilbert, what do you think in terms of how is 2021 going? What do you see for the future? And obviously, I'd like you to be, to be able to read it. But in reality, what is in your mind? What do you expect? Return to volatility or going even lower? And what are the strategies implemented at the moment that you can share with us? Thank you.
Yes, of course. So before answering to that question, maybe coming back to what Massimo was saying about liquidity, which is crucial for us. One of the reasons why we are using listed derivatives is for this reason is to have the liquidity we need for our active management during period of stress. Most of the time, the options we are using are index options. It's true that the liquidity is even better on index options. But for sure, going into listed versus OTC is a decision we made a long time ago. It's not a new decision. Amundi has always managed this kind of strategy with listed derivatives, and we faced two major crises with 2008 financial crisis and 2020 COVID crisis, where in both cases we have shown that having made this choice, being listed, had enabled us to offer this active management in a, I would not say without any cost, but at least with a very good liquidity and a good bid-ask spread in that market. And now coming back to your question about what kind of strategy could be powerful in 2021. We are not expecting, so in our central scenario, we are not foreseeing volatility to go back to low regime as we used to have before COVID, because uncertainties are still there. And we think the recovery will be choppy and the road will be bumpy. So, but at the same time, we are not also expecting any crisis like last year. So it means we are most foreseeing volatility to stay in this medium level with episodes of stress sometimes during the year, and that's the reason why we think that again active management of derivatives is crucial, because if you are just a buy and hold investor, you know, you are paying a premium with the derivatives if you are a buyer. If you are not managing it actively, you will lose the premium at the end of the day. So for me, either you will go for strategies, you need to go for strategies which are offering protection or convex profile, and then you need to have an active management of this strategy. So when you are buyer of options, you need to manage actively. Or if you want to maybe take advantage of this shift of volatility regime, you can also, some strategies of volatility premium could be interesting, you know, systematic selling of options could be also interesting, but you need to be careful because there are tons of different strategies doing that. We are at Amundi, we are also managing volatility premia, but on a multi-asset point of view and with different kind of strategies, in order also to mitigate the drawdowns of such strategy, because when you are selling options, you know that the risk of losses are unlimited by definition, and you need to manage it very carefully. So that's the reason why, if for investors who wants to go in this kind of premium earning, getting some yield with a very good diversification, again, you need to be careful on the strategy you are choosing and the manager you are using, because you need somebody with a great experience in managing derivatives. So to summarize, either more buying vol strategies but actively managed, otherwise you will lose money, you will use the carry, or if you want to get some carry, go for systematic selling strategies, but managed by professionals, I would say.
Very interesting, and yeah, I think that you know, the kind of back to normality, that mood that we are all already feeling, we have started seeing as well in the pipelines of particularly IPOs back in Europe. Obviously, that COVID crisis went a bit longer in the primary market, but now is definitely, you know, the comeback to market is very encouraging. So, you know, before thanking you, let me recap what we learned today. I think that, you know, the key messages that I got from Gilbert have been enhancing the risk-return strategy, and as well is that, you know, the role of derivatives is not just downside protection or upside participation, is really the importance of actively managing those products in order to you know, enhance the portfolio and to improve its liquidity. Massimo, also a part of you know, the CPI functionality, the interesting point that you know, that made was the exchange role to raise the bar, enhancing the market structure and improving the evolution, you know, then following the evolution of the market liquidity. So the two key words of today are probably enhancement, which you both use, and liquidity. Thank you. Thanks a lot, Gilberto. Thanks, Massimo, and see you soon.
Thank you. Have a great day.
Thank you, you too. Grazie.